Broker Daily Uncut.
Broker Daily Uncut.
News, views and opinion about what's shaping Australia's mortgage and finance industry.
Welcome back. Great to have you with us. Broker Daily Uncut. We've got the gang here. Eva, Costa, Alex with you this morning.
Nice to be here.
Quite a bit to chat about today, but I'd like to kind of kick off. Look, I would like to touch on, obviously, we need to talk about rates. We need to talk about what the impact will be on the marketplace. And I'd like to dig into that in the second section. But I'd like to kick off looking at the first week or the weekend of any reasonable activity in the marketplace. And I think given that, the rate news, it's been a pretty hot weekend of auctions. Now, look, let's remember that, the market is still warming up. That stock on market is still fairly low. You've got that sort of tail end of listings from the end of the previous year and what's sort of come on the market. But it's been a pretty hot market from what I gauge from Cotality data. Now, there's different data across the board. Everyone releases their own, and some of the numbers, Costa, we were sort of talking off-air, don't match up. Domains figures are different to Cotality, but I found that this is to be the most reliable. So Sydney, you're looking at 79.6 clearance rate. That's
really good.
That's the Sydney region. It breaks, obviously, Cotality break it down into the various areas, but that's pretty hot.
It is.
I'll just run through quickly so we can kind of, sort of go through. So you got 79.6% clearance rate on 455 for Sydney. Melbourne, 470 properties taken to auction, 67.9. That's pretty tepid in contrast. Brizzy, only 100 properties taken to auction, 69%. Adelaide, 73, 83.6%.
That's great, wow.
Perth, obviously, is not an auction market. Tasmania, no activity. Canberra, 66 and 69.7. Gives you across the combined capitals, 73.7, which is a bit meaningless. But you kind of got to look at them, in their isolation. Now, tight stock, but are you surprised at the heat in Sydney based on those numbers?
No, they're actually really probably better than what I expected, but there's just not enough properties, and we've discussed this multiple times over the podcast, where there's just not enough properties for what people want to buy. So the auction results show that. Those sort of numbers for probably the first week back really in the auction market is actually really, really good.
Yeah.
I would love to revisit those in probably about a month or two when everyone's really back into action. Mm-hmm. I wouldn't be surprised if we're going to be seeing high 80s, especially in Sydney. Adelaide was really impressive from what we saw. So it seems like it's heating up over there as well. Melbourne will probably increase throughout the year.
It looks like Melbourne's going to be a slow burner, the way the things are going. I look at the Melbourne market and I see significant pent-up opportunity, but I think on the ground, it's a different matter down there from buyers within Melbourne. I think you're getting some interstate investors looking at grabbing certain opportunities, but I think there's still that kind of hesitation around the Melbourne market. So it might take a little while for that to heat up. But Adelaide's still running hot.
Yeah.
You see much inquiry from your customers. Where are they looking to buy at the moment?
Not really through Adelaide. There's a few buyers agents that still work there and buy there. From what...
Still Perth, is it?
Perth a lot, yeah. And Melbourne. But what we heard pretty much last year quite evenly from all buyers agents we work with is that Adelaide had reached its top.
Done its dash.
And that was it. But we also heard that from Perth, and it's not the case, right?
Yeah.
Still running hot. So, but from that, actually, those numbers don't really surprise me because every professional we talk to, like buyer's agent, accountant, financial planner, they're already back full swing into the year and really, really busy. So it doesn't surprise me. I almost want to say like what's happening with the RBA interest rate have pushed people to act quickly.
Yeah.
Whatever they were going to do, it's like, well, we need to do it now before there's more.
Interesting, yeah.
Yeah, I feel like investors especially are like, well, let's get in quick.
Or could you say in agreement with Eva, could you say as well, after the last, 11 interest rate rises, that people have seen the market during that period going, all it did was go up.
Yeah.
And then people probably are looking going, well, one interest rate rise, like it means nothing to the market anymore. If 11's not going to do anything, what's one going to do? So I still need to hit the market regardless of what interest rates are doing.
Yeah. In terms of investing, I think it's also, anyway, the investors we work with are pretty aware of how it works, and they know their capacity to borrow will go down with that. So they don't want to be priced out too quickly. Like one hike is not going to do much, but still can limit your capacity. So if it's going to keep going.
You don't, with the auction clearance rates, you don't know what it is that's selling. You just know they've sold at auction, and you don't know who's buying.
It'd be interesting to see by markets,
you've got stimulus
price range,
in certain sectors across all the capitals, with the first-time buyers, with government incentives. So, but hey, if you're in the business of real estate, the news is good.
Business.
Yeah.
It's going to be interesting to see. You're going to get more properties coming on the market as we sort of wear through, from summer, into autumn, and then you're going to probably see a little bit of a slowing as you get into the winter months. But yeah, it's looking fairly positive.
Looking very positive.
We'll talk about interest rates in a moment or two, but again, we've had one hike. A lot interest rate movements are cyclical. I can't ever remember there being one increase followed by a decrease. In fact, the last sequence of decreases to an increase is probably the shortest on records. So where they go from here is going to be very, very interesting, and what signals are being sort of sent out to buyers and borrowers is going to be interesting. We'll take a quick break there, guys. We'll look at it more closely when we come back. Welcome back, Eva, Alex, Costa with you. We're going to dive into rates. There's been the first increase for Costa. How long? Throw you under the bus there.
Yeah.
A couple of years?
Yeah.
First year, probably about 2.5 years.
Yeah.
Give or take, yeah.
It was, although it was largely and widely expected, the kind of the change in temperature came around fairly quickly. It was looking like, we were on the beginning of a downward cycle that obviously, as economic data has sort of come through and the economy has heated up and there have been changes to, employment levels and a number of other metrics, it very rapidly looked as if any sort of downward rate movements had come to a halt and then no longer a pause, and then up we go. So before we get into sort of what this means in terms of borrowing, are we looking now at an upward cycle, I wonder?
I don't know. From what I was gathering from talking to a lot of different professionals, it is the increase that will stop what's going wrong, and then we'll see a pause. So it was like the one that saved the issue in the future, maybe like a preventive type of thing. And I hope so for our borrowers that are struggling. But the banks, I don't think are agreeing with that and can see a cycle going up again.
Well, we can, as we sort of, unpacked in the first section, it's not really had much of a dampener on the property market. And as Costa, you sort of quite rightly pointed out, when we went through the upward cycle, people were still buying. So it would seem that, look, the RBA doesn't focus on, it's not the property market the RBA is focused on. There are other factors that they want to cool down the economy. But, the property market is obviously, so a significant consideration, certainly for our audience. What are you seeing what's the lender reaction been to the RBA move?
So obviously they're all passing it on.
Yeah.
By at least what it's been. I think what we need to think about as broker is really how to, I guess, compensate for that hike with a bit more strategic lending and thinking around, well, this obviously is going to affect how much you can borrow, but there's always another solution. You might go from prime lenders to second tier lender, or there are some that offer less buffer on their assessment or cheaper interest rate, or we reduce the credit card. There's always something that we can do. But with what's happening with DTI as well, we find that a lot of our borrowers very quickly reach capacity. And I think this year will be very much about how we navigate a ceiling that's probably a lot lower than what the price range people are looking at. So there's a gap there for sure.
It's going to be interesting. I think anyone that's going through the application process or maybe moving, sort of towards either a refi or a purchase, it's an increase in terms of you got more money going out the door. So it's a consideration for borrowers and for brokers when you're in that sort of in the process. If you're thinking about refinancing, look, there will be, you'll get a wash-on effect. For investors, there'll be a wash-on effect further down the track around rental income, because as rates go up, the cost for investors, property owners and landlords goes up, and that does wash through into the market.
Yeah, we'll see that. And I think we're already seeing that, even as it went down anyway. I guess it's also supply and demand. There's more investors in the market, obviously, that pumps up pricing.
Prices up, yeah.
And then there's obviously less for first-time buyers to buy, so they have to rent, and it's a whole cycle.
It's just a vicious cycle,
Yeah,
and
yeah.
I know the government tries to solve all these problems, but I don't know.
The solution.
Yeah, I don't know what the actual solution is, because in the end, if you're trying to get investors and pump up interest rates, that's just going to go straight over to higher weekly rents, and then I just don't know what the solution is, and they're trying to attack the purchasers, and then they're trying to help the tenants, but you hurt one and then you hurt the other.
Yeah,
it's a weird.
I've got no idea, but it feels to me like the government wants to have all bases covered. They want to make lots and lots of money out of taxes from property. It's pretty significant. What buyers pay out, and if you're an investor, you get absolutely fried. But you've got to run a country. You've got to raise geographically an extremely large country.
Yeah.
And you've got to spend a lot of money across the board, and that money has to come from somewhere, right? So property is a kind of a fairly straightforward and easy way.
You're from, I guess, an outsider, coming from France.
I'm an outsider too.
Yeah, that's correct. Australia is so heavily reliant on properties.
Yeah, it is.
Right? It's like every time you need to fix or correct something, it's okay, let's see about property. But at the same time, they want that market to be really strong because you rely on that, right? So, it's it was very interesting for me coming here to realize how much
we're invested in property.
You've got Australians' attitudes to property, and it's still what people expect and want in terms of home ownership is very different.
Yeah, but all policies, government, they all rely on that too to correct the whole economy. Right?
I guess there's just a lot of money to be made in property from a government point of view, because obviously everyone wants it. It's a very safe asset. It can give you a good return in retirement. So that's why people gravitate towards property, I guess, over shares and stuff like that, or Australians specifically. And then I guess the government just wants its share of that. And as we invest in more and more, prices are going up higher. They're like, well, we can grab a larger pie of what's going on, and it means more money for the government. So they're happy to just go after property.
That's this discussion about the GST tax.
Yeah,
as well
and
is
the CGT tax that they're talking about at the moment. The CGT concession tax is 50% for when you sell a property. They're thinking to move it to about, well, depends what media reports you read, to about 25 to 33%. So say, for example, you make $100,000 on a property, 50% of that at the moment doesn't get taxed. They're thinking to reduce that down to 33 or 25%. So they're saying, they're doing it to help the supply and the affordability of property. But when you look at it, it basically is just revenue raising. Nothing of that is going to increase supply. Maybe in the short term, when
people are going to panic sell.
People are going to panic sell. They're going to be like, well, I planned on selling in October, and the policy comes in June. They're going to push it to June so they don't pay more tax. But in the long term, it's going to be harder for developers to stack up because they've got to pay more tax. It's going to be harder for investors to sell because, well, they're going to have to pay more tax. It makes no sense whatsoever. And regardless of how the government spin it, it's basically just more revenue raising. And back to what you were saying before, they just love going off. They just love going to property because there's money to be made.
It occurs to me government doesn't really understand the property market. it understands the dollars that it can squeeze out of it, but
Yeah.
there's been various commentary over the years around election time around negative gearing, and it's a very complex system. And government, you got to remember, looks at the whole of the economy and every facet, and they'll have a bit of a glance over the property market, and will make assumptions, And if you get rid of investors, because it's already reasonably unattractive as an asset class for investors. You're really reliant
It made it
now.
hard. Like in Victoria, it's really unattractive these days.
You're really reliant on capital growth, and if you take away any opportunity to benefit from capital growth, there's very little yield. You get taxed to hell along the way. So at the end of the day, you buy property as an asset class, and you look at a return on your investment, and those returns are very, very greatly diminished in terms of a yield. So then if you reduce any opportunity from capital growth, which isn't guaranteed anyway,
it's going to be difficult.
People who have money to invest will invest in other asset classes, and there's plenty other to choose from that are an awful lot less punitive than property.
Yeah. Well,
anyway.
I think the CGT tax has come into play because they did try to go after negative gearing, and then everyone blew up about it because everyone is affected. Whereas the CGT tax, I found they're talking about it in the media, but there's not much backlash to it, because in the end you have to sell the investment to be hit with the tax.
Yeah.
So people are looking at it going, okay, cool, I don't like it, but I'm not.
I'll worry about it later.
Or I'm never going to sell, so it doesn't affect me yet.
Well, you make a good point, because negative gearing, any change in that hits everyone simultaneously there
100%.
and then. CGT is staggered because I might not get up in arms, and if I'm not planning on selling, you're
only selling
reaction.
for a reason. Like if you're not selling just to sort of sell for the sake of it, there's a reason why. So I feel like they're not coming down hard on the government for this, and I think that was sort of the government just throwing it into the media to see what people are saying.
I know a bloke who will on smart property investment. I'll leave that to Phil Town. We'll take a quick break there, guys. Back in a couple of minutes. Welcome back. Great to have you with us again. Eva, Costa, Alex with you, Broker Daily Uncut. Just looking at the lenders, you stumbled across something not major, but that sort of gone under the radar a little bit with just in and around trust-based lending.
Yeah, so we've discussed that many times. Trust is becoming really the area this year that's going to be really scrutinized, and banks are making all sort of policies and restrictions around it to slow it down and probably make sure that people investing through trust are doing the right thing and not going to be in trouble later on when they actually can't make the repayments. I didn't actually see CBA announcing this. I found that out through different newsletters from other professionals, that CBA is actually limiting cash out from trust and company lending to 60% LVR.
Do we know this for a fact?
I haven't contacted CBA to check.
Okay.
But I would think
it'd be good to get some clarification on that.
Yeah. So if that's the case, that's really reducing, the idea of an investor buying a property, holding it, getting cash out, investing again, getting cash out, investing again. 60% is very restrictive.
Just come back again to sort of what we'd run through in the previous section. It's getting harder.
It's getting harder
for investors, and I mean the value brokers is we're preaching to the choir here, but particularly from an investment perspective, if you are looking to build wealth through property, whether it's through your SMSF or whether direct, it is so complicated. Making the wrong decisions around how you finance your investment journey now, and understanding having advisors that can just give you some visibility around the sort of quagmire of taxes and penalties, both down the path and when you come to sell, and then the structure that you go into, how you structure. There are benefits. There are benefits with trust structure to minimize the impact of taxation, to safeguard your portfolio and to make it a generational thing. So how lending feeds into that is obviously a critical thing. It's a complex business.
Yeah, and I think the reason why people would invest through trust lately wasn't so much asset protection and tax benefit, it was lending opportunities. But what you would see here, if someone went to CBA today, bought a property at 80%, not knowing this rule, in 2 years' time, when they're trying to invest again, realize they can't cash out, they would have to refinance somewhere else. If anything has changed in circumstances or the property isn't positively geared, they can't move, they can't refinance, they can't extract equity, or they're stuck.
Yep.
So this is becoming a bit of an issue. I've had some submission as well in the last few weeks where officially there's no rules against the trust lending. There's no new policies, but they're asking so many questions. They really want to tick the box on, is it positively geared? What's the rent? What's the actual outcome? What's the cost on the property? Blah, 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 which we never had before.
Yeah.
So it's, it's, I think if you are thinking of buying through a trust this year, it has to be solid. It has to be a solid property, close to being positively geared from the beginning. Otherwise, it would be a struggle.
I do know investors, with large portfolios that don't bother using a trust. And,
yes, correct.
They're happy to buy in their own name.
It is common.
Yeah, it's common.
But I think, like we ever said previously, a lot of social media chat has sort of made it a thing where, you can get around certain rules and regulations, and that's probably why the lenders have come down hard.
Very bad counsel.
I don't know, like trusting someone on social media, and
it's a shame because it is a good strategy. It worked very well. It's just been abused a bit, I think.
Yeah. And then now we're in situations like this where I think a lot of people will be stuck. And, when they go to find another property, they're going to be like, why can't I do that anymore? And then, it's going to be
It's so funny if I cast my mind back, to when I were a lad. I'm 58 now, but when I was sort of coming out of school, going through university, property as an investment was something which was really not for everybody. Certainly in the UK, and it's only a recent thing that everyone can get into property investment. Theoretically, I know the prices have gone up, but my son bought without any help or assistance from us. You organised a mortgage for him. He bought in Perth. I don't know, 4 years ago.
Great.
So you can still do it. But here's the thing now. I look back to 40 years ago, and property was for the elite. We're now talking about, as common and garden stuff, trust structure for just punters. It's a crazy scenario.
It is. Yeah, I'm actually wondering what's the percentage of the population. Like, obviously, your son or your daughter have heard you. Like, I guess they're born in people investing. It's not a normal thing for them to do. I'm just wondering what's the percentage of people that come from family, maybe there's no investing. Yeah. They just bought their home and that was it, that are changing the mindset to actually investing rather than buying their home.
You go back to social media though.
Yes, it's all over the place.
Obviously,
information's there.
Thankfully, I was born long before there was any social media around. I enjoyed many decades without it. And I'm not on social media. I'm not even on LinkedIn. I don't like it. But you raise a really good point. Social media now, this is the fickle nature of social media, where it's just clickbait for people to look at the people who produce the content. It's not really, in many cases, about adding any value or giving any real insights. It's just attracting people to look at a certain person that has a particular agenda. Yeah,
and it's normalizing the investment thing. But look, when I talk to my friends, like, I'd say most of them have invested, but they keep it very, like, one or two properties tops, and they are the first most of the time to do it. Like, their parents haven't. Yeah. And they're still in their 40s,
my parents
40s plus. Yeah, so I think it's
do your parents have investment property? No. Costa?
Yes.
They did, okay. Yeah, well, my parents were...
I think back in Europe it's a bit different as well.
Yeah, it would be, if anyone had an investment property, if anyone was a landlord, you go along and you're in rent.
You said that
we heard it though, you said it.
I didn't know anyone who was a landlord in the UK.
They would have. People would rent properties. So
yeah.
But renting is a very big market in Europe, isn't it?
But you can rent for 30 years, so it doesn't really...
People rent all their lives.
Yeah, that's like in Greece. It's very common to rent. And the first time I went there, I was like, okay, like everyone rents.
Yeah, a lot of people
and it's just
do,
normal.
Yeah.
But it's very different compared to here.
Yeah.
Very different.
But you'd spend a whole life in one house, right? Renting it for 30 years.
Yes, people do, yeah. Anyway.
It's not the case, yeah. Interesting.
I think the whole situation right now, given that people do have trust structures, whether they should have had them in the first place, is kind of immaterial if they've gone ahead and got themselves into that. And if they have lending structured around that, then there is a sector that needs to be catered for. So, look, talk to your broker.
Your financial planner.
Or your financial planner.
Yeah.
All right, guys. Thank you very much. Great to have you
Thank
with us.
you.
Got the professionals. I love it when these guys are here. Not that I don't enjoy talking to my friend Philip Tarrant, but it's a different kind of conversation. For everyone else tuning in, we love having you with us. Keep the comments coming. Have a fantastic week. We'll talk to you next week.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.